The mathematical framework governing global derivatives rests on a specific assumption about how markets behave. On October 19, 1987, reality fractured that assumption completely. The Dow Jones Industrial Average dropped nearly 23% in a single session. Portfolio insurance strategies, designed to systematically sell futures as prices fell, created a mechanical feedback loop of panic selling. That crash exposed a fatal flaw in the Black-Scholes model. The formula required the underlying asset to have constant volatility, dictating that market returns would always follow a predictable log-normal distribution. This split-screen visualization compares that theoretical expectation with market reality. On the left, the model's math produces a smooth bell curve, where extreme crashes are statistically impossible. On the right, post-1987 empirical data reveals fat-tailed distributions and a steep volatility smirk, proving extreme downside moves are a permanent feature of equity markets. The math is objectively contradicted by the data. But the fallout of 1987 didn't lead to the model's abandonment. Instead, practitioners began using it for a purpose the original paper never fully envisioned. To understand how a broken formula runs the financial world, you have to look at how modern trading desks actually operate. Practitioners do not use Black-Scholes to find a fair price for an option. This flowchart illustrates the model's actual function. It acts as a nonlinear translation layer. It ingests raw, observable market prices and processes them into a single, stable metric, implied volatility. Quoting in implied volatility allows a trader to look at a short-dated tech stock option and a long-dated index option and compare them on a common scale. Raw dollar prices scale mechanically with the stock price and time to expiry, masking the underlying risk. Implied volatility strips those variables away. Modern quantitative finance treats Black-Scholes as a standardized unit of account, providing a shared language that keeps the entire global market comparable. This is the stochastic differential equation for geometric Brownian motion. It models the underlying asset price, representing the constant expected return, the drift, and a jagged volatility path attached to a standard Brownian motion. Because Brownian motion paths have infinite variation, standard calculus fails here. We apply Ito's lemma, which introduces a specific convexity term generated by finite quadratic variation. This extra term is the mathematical engine responsible for all convexity effects in derivatives pricing. Fisher Black and Myron Scholes realized they could neutralize this randomness. They constructed a theoretical portfolio holding one long option, offset by shorting a specific fraction of the underlying shares, a ratio called delta. By continuously adjusting this delta position as the stock price moves, the portfolio perfectly cancels out the stochastic term of the equation. The randomized risk is stripped away entirely. Because this specific portfolio is now instantaneously riskless, the ironclad rule of no arbitrage dictates it must earn exactly the risk-free rate of return. If it earned anything else, unlimited free profit would exist. This delta hedging maneuver eliminates the investor's risk preference and the stock's real-world drift from the valuation entirely. It creates an objective mathematical framework for isolating and managing risk. That is the elegant academic theory. On the trading floor, the math is run in reverse. This diagram displays the theoretical pipeline. You input the stock price, strike, interest rate, dividend yield, time to expiry, and your assumed volatility, and the model outputs a theoretical option price. Desks actually operate backward. They observe the real traded market price, plug that dollar amount in as an input, and isolate the volatility variable to see exactly what variance the market is pricing in. There is no closed-form inverse for the Black-Scholes formula. To extract that volatility, computers run numerical root-finding algorithms, rapidly guessing and refining inputs until the model's output matches the observed market price to the decimal. This numerical inversion transforms an academic paper into a live diagnostic tool, actively extracting the market's true expectation of future variance millions of times a second. This 3D graph plots strike price, time to expiry, and implied volatility. If the original Black-Scholes assumption of constant volatility were true, the market would look exactly like this, a perfectly flat, uniform plane across all strikes and maturities. When we plot actual empirical data over that assumption, the flat plane warps into the volatility surface. The market systematically varies implied volatility across different expiration dates and strike prices. Look closely at the equity smirk. This severe negative skew shows out-of-the-money puts trading significantly higher than equidistant calls. This is the permanent, mathematically mapped scar tissue of the 1987 crash, reflecting a persistent premium for crash protection. The resulting 3D volatility surface functions as a precise map of risk. Every curve and skew in the geometry marks a specific coordinate where the model's original assumptions broke down. Modern trading desks do not manage books based on raw dollar exposures. They fracture their risk into isolated sensitivities known as the Greeks. Delta acts as the baseline hedge ratio, the exact number of shares required to neutralize small price moves. Gamma measures the convexity, indicating the rate at which that delta changes, driving the frequency and cost of rehedging. This equation is a Taylor expansion used for daily profit and loss attribution. It isolates the specific contribution of delta, gamma, vega, theta, and rho, summing them up to explain the total risk and return of a trading book at any given moment. The Black-Scholes math assumes continuous, frictionless trading. In the real world, transaction costs exist, creating a dynamic called gamma scalping. Market makers rebalance on discrete schedules, trading off residual hedging errors against the cost of trading. An options desk's profitability is rarely driven by predicting which way an asset will move. It is driven entirely by the spread between the implied volatility they sold to the market and the actual realized volatility they physically edge against over the lifespan of the trade. When institutions price highly complex, path-dependent, or exotic derivatives, the vanilla Black-Scholes framework is insufficient. The constant volatility assumption cannot handle payouts sensitive to the actual dynamics of the smile. This chart maps out the specialized extensions engineered to patch the base model's known theoretical holes. From the Black-Scholes Foundation, quantitative analysts developed local volatility, jump diffusion, and stochastic volatility models. Stochastic volatility models like Heston upgrade the math by treating variance itself as a mean-reverting, randomized process. This captures the correlation between price drops and volatility spikes, allowing the model to realistically match the dynamics of the volatility surface over time. But regardless of how computationally heavy these advanced models are, their final output quotes are still translated back into the original, universal language of Black-Scholes implied volatility for the wider market to consume. These complex pricing structures are held in place by model-independent realities. The most important is put-call parity, a strict no-arbitrage rule that grounds all derivative pricing, regardless of the volatility model being used. This table visualizes the put-call parity equation. By plugging in the market price of a call minus a put and comparing it against the discounted spot price minus the discounted strike, the scale balances perfectly to the third decimal place. This fundamental law ensures that calls and puts on the same strike maintain an exact equilibrium. It dictates that no matter how complex the volatility model becomes, it is bounded by the strict physical laws of arbitrage. This framework has navigated extreme modern crises. During the COVID-19 crash in March 2020, implied volatility spiked to record levels, yet the options market continued to process risk, clear trades, and recalibrate surfaces dynamically. Black-Scholes is objectively, mathematically, and empirically wrong about how human markets actually behave. It assumes continuous trading without gaps, zero transaction costs, and a constant risk-free rate. Yet the global derivatives market is a vast, interlocking machine that only functions because every single participant agrees on the exact dimensions of its flaws. Because the model's specific failure modes, the smile, the skew, the term structure, are universally mapped and understood, practitioners don't need a perfect model. They just need a standardized one. The Black-Scholes model provides the primary scaffolding for global risk management. It is the translation layer that allows a chaotic market to communicate in a single, mathematically rigorous language.